So you want to understand the credit card business. Maybe you've wondered about it while paying off a balance, or maybe you just got a shiny new card in the mail with a big signing bonus attached and thought, how does anyone actually make money on this? On the surface, it looks simple. A bank lends you money, you spend it, you pay it back, and somewhere in between, the bank profits. Millions of people carry a card in their wallet right now. In a lot of countries, plastic and digital payments have quietly replaced cash for most everyday purchases. It's one of the most widely used financial products on Earth, and for a huge number of people, it's become a daily habit without them even thinking about it. So the credit card business should be easy to understand, right? Lend people money, charge them interest, collect the payments, keep the difference. But that's almost never the full picture. Because the moment you look past the plastic, you realize you're not looking at one business. You're looking at several businesses stitched together, all competing for the same swipe. Open your wallet and you'll probably find cards from different banks, different networks, maybe a store card or two. Some are massive global players. Others are smaller regional banks or credit unions. And every single one of them is fighting for the same thing, to be the card you reach for first. Here's something that surprises a lot of people. A credit card company's biggest competitor isn't necessarily another credit card. It's your debit card sitting right next to it in your wallet. It's the Buy Now Pay Later app that lets you split a purchase into 4 payments with no interest. It's the mobile wallet on your phone that lets you tap and pay without even opening your wallet. It's cash, still stubbornly used in plenty of places. You're not just competing with other card issuers. You're competing with every single way someone can pay for something. So why do banks keep pushing so hard to get a card into your hands? Because when it works, a credit card becomes something far more valuable than a single purchase. It becomes the default way someone pays for almost everything, and being the default is worth an enormous amount of money over time. Think about your own spending. A lot of people don't think about which card to use anymore. They just tap the one already sitting in their phone case or saved in their favorite app. Same card for groceries, gas, subscriptions, dinner out, online shopping, nearly everything. That habit is incredibly valuable to a bank because unlike a loan you take out once, a credit card gets used again and again, sometimes dozens of times a month for years on end. A single cardholder who spends a couple $1,000s a month and carries even a small balance here and there can generate real revenue for a bank year after year. Multiply that across millions of cardholders, and the numbers start to look enormous. But getting someone to actually choose your card and keep using it is far more expensive than most people ever realize. Before a bank earns a single dollar from you, it's already spent money trying to get you as a customer. Marketing comes first. Direct mail offers, online ads, airport lounge partnerships, glossy commercials during major sporting events. All of it costs money, and acquiring a single new cardholder, especially for a premium card, can cost a bank a few $100s before that person ever makes their first purchase. Then come the sign-up bonuses. Those tempting offers, 60,000 points here, a few $100s in cash back there, aren't charity. They're a direct cost the bank absorbs, betting that the new cardholder will spend enough and stick around long enough to make that upfront cost worth it. Then comes underwriting. Every applicant has to be evaluated, credit history pulled, income considered, risk scored before a bank decides how much credit to extend and at what interest rate. This isn't free. Banks employ entire teams and build sophisticated risk models just to make that decision quickly and accurately, because approving the wrong applicant, someone likely to default, can cost far more than any marketing budget ever would. Then comes the infrastructure most cardholders never think about. Fraud detection systems running in real time on every single transaction. Customer service centers staffed around the clock. Statement processing, mobile apps, security chips, tap-to-pay technology, dispute resolution teams for when a charge looks wrong. Every swipe, tap, or online checkout has to be processed, verified, and settled in a fraction of a second. And all of that technology has to be built and maintained continuously. And then there's something most cardholders never think about at all: rewards, cashback, points, airline miles, hotel status. Every dollar of rewards paid out is a direct cost sitting on the bank's books, and premium cards with generous rewards programs can end up paying out a significant chunk of what they earn on every dollar spent, just to keep cardholders loyal and spending. Some banks even partner directly with airlines and hotel chains, buying miles and points in bulk to hand out to cardholders. Hopping the loyalty those rewards create is worth more than the cost of funding them. But even the most generous rewards program can't save a poorly run card business. Because here's the part that surprises a lot of people. A credit card company doesn't actually make most of its money from cardholders who pay off their balance in full every month. That sounds almost backwards, since paying on time is exactly what everyone is told to do. But once you look at where the real profit comes from, the picture looks very different. And once you understand that, you'll never look at your own card statement the same way again. Part 2. Transactors, revolvers, and where the real money comes from. So now the card is in your wallet. The account is open, the app is set up, the rewards are ready to start racking up. From the bank's perspective, the real business is just getting started. And here's the surprising part. The moment you make your first purchase, the bank isn't really thinking about that transaction anymore. It's thinking about your behavior over the next several years. Because in this business, a single swipe barely matters. What matters is the pattern. Do you pay in full every month, or do you carry a balance? Do you use the card constantly, or does it sit forgotten in a drawer after the sign-up bonus is claimed? Do you stay a loyal customer for a decade, or close the account after year one? Every one of those behaviors determines how profitable or unprofitable that cardholder actually is. There are really two very different types of cardholders driving this business, and banks think about them completely differently. The first are often called transactors, people who pay their full balance every month and never carry debt. For a bank, transactors are actually not very profitable on their own, because the bank never collects a cent of interest from them. The second group are called revolvers, people who carry a balance from month to month and pay interest on it. Revolvers are where a huge share of a credit card company's profit actually comes from, because interest charges, often well into the double digits annually, add up fast on an unpaid balance. Take a cardholder carrying a balance of $2,000 at a typical credit card interest rate. The interest charged over the course of a year alone can be worth more to the bank than what that same person spends in swipe activity through the transactor side of the business entirely. That's why credit card profitability, more than almost any other financial product, depends heavily on cardholders who don't pay in full. Even though every card agreement, every statement, every piece of financial advice tells people to avoid exactly that. That's why the entire structure of a credit card is quietly built to encourage ongoing use, and for some cardholders, ongoing balances. Minimum payments are set low on purpose, just enough to keep an account in good standing, while a much larger balance continues accruing interest month after month. Grace periods reward people who pay in full, but the moment that grace period is missed, interest can apply retroactively to the entire balance. None of this is hidden, it's disclosed in every card agreement. But the design of the product itself nudges behavior in a direction that benefits the bank's bottom line. But interest from revolvers is only part of the picture. Every single time a card gets swiped, tapped, or entered online, the merchant accepting that payment pays a fee, called an interchange fee, split between the bank that issued the card and the network that processed it, like Visa or Mastercard. That fee is usually a small percentage of the transaction, but across billions of transactions happening every single day worldwide, it adds up to one of the largest and most consistent revenue streams in the entire industry. And unlike interest income, it comes in regardless of whether the cardholder ever carries a balance at all. That's why successful card issuers don't just want you to have their card. They want you to use it for everything. Groceries, gas, streaming subscriptions, online shopping, even paying bills that technically don't need to be paid by card. Every swipe generates interchange revenue, which is exactly why rewards programs exist in the first place. They're not a gift. They're an incentive engineered to make sure the card stays on top of the wallet or set as the default in your phone instead of getting ignored in favor of a competitor's card. Building loyalty like that costs money too. Every points program, every travel partnership, every premium perk like airport lounge access or purchase protection has to be funded somehow. And unlike interchange revenue, which arrives automatically with every swipe, reward spending is a direct cost the bank has to plan for and absorb. Hopping the increased usage and loyalty it buys is worth more than what it pays out. Then there's fraud and risk, one of the biggest hidden costs in the entire business. Stolen card numbers, data breaches, identity theft, disputed charges, all of it has to be monitored, investigated, and often refunded to the cardholder, with the bank absorbing much of that loss. Fraud detection technology has become incredibly sophisticated, using real-time pattern recognition to catch suspicious activity within seconds of it happening. But fraudsters keep adapting just as fast, and the cost of staying ahead of them never really goes away. Then there's default risk, arguably the single biggest threat to profitability in this entire industry. When a cardholder stops paying entirely, the bank doesn't just lose future interest. It loses the outstanding balance itself, often thousands of dollars per account. Banks build enormous risk models trying to predict who is likely to default long before it happens, adjusting credit limits and interest rates accordingly. But no model is perfect, and during economic downturns, default rates can spike sharply all at once, wiping out profit that took years of interest and interchange revenue to build up. That's why underwriting and ongoing risk monitoring matter just as much as marketing and rewards. A bank that approves too many risky applicants chasing growth can end up buried in losses within a couple of years. A bank that's too conservative misses out on the volume needed to make the whole business work. Finding that balance is one of the most important and most difficult jobs in the entire industry. Part 3. Risk, downturns, and the fight to stay competitive. At this point, the credit card business might sound like an endless list of costs, incentives, and risks all pulling in different directions. And honestly, in a lot of ways, it is. Because even if millions of people are actively using a card every single day, even if the brand looks strong, even if sign-up numbers keep climbing, there's one thing that ultimately determines whether the business stays healthy. Credit quality. A card portfolio can look enormous and successful on paper, with millions of active accounts and constant transaction volume, and still be quietly in trouble underneath. Why? Because volume alone doesn't guarantee profit. Managing risk across an entire portfolio of accounts is where the strongest issuers separate themselves from everyone else. And that's really where the deeper economics of this business begin. By now, a healthy card program is running at full scale. Applications are pouring in, existing cardholders are swiping constantly, rewards points are racking up, and the bank's marketing team is celebrating strong growth numbers. From the outside, it looks like an obvious success. Analysts point to rising cardholder counts. Executives highlight transaction volume. It all sounds like the business is thriving. But underneath, the real numbers tell a more complicated story, because growing the number of cardholders doesn't automatically mean growing profit. In fact, one of the most common mistakes in this industry is chasing volume without properly accounting for risk. Say a bank issues 100,000 new cards in a year, and cardholders collectively spend $1 billion on them. Sounds enormous. But before celebrating, the real costs come due. Interchange revenue gets split with the network. Rewards have to be paid out on nearly every dollar spent. Marketing and acquisition costs from the initial sign-up have to be recovered over time. Fraud losses get absorbed. And a portion of that $1 billion in spending will inevitably belong to cardholders who eventually default, wiping out far more profit than their spending ever generated. This is why experienced card issuers don't obsess over how many people signed up. They obsess over long-term account profitability, measured over years, not months. A cardholder who spends heavily, pays interest occasionally, but never defaults, can be worth an enormous amount over the life of the account. A cardholder acquired with an expensive sign-up bonus, who uses the card briefly and then closes the account, can end up being a straightforward